joining me right now to talk more about that is Mahoney Asset Management CEO Ken Mahoney. Ken, great to see you. So we are waiting on the Senate Banking Committee hearing this morning and what comes out of it about the failure of Silicon Valley Bank and Signature Banks. What are you expecting, Ken? Does this become a market mover for investors?
It could be. Look, March is definitely like March Madness without the basketball with all this going on. I think we're going to learn some of this wokeness we've been speaking about. You have 12 board members, one of which has banking experience, 11 do not. They made a lot of risky bets. They were not operating like a bank. I mean, look at JP Morgan, look at the big nationals. You know, when they make a loan, there's, you know, they do the different ratios. You're going to find out there's a lot of loans that probably shouldn't have been made. And then, of course, you had to run on the bank. And by the way, I think other CEOs should wake up there in the banking sector, and they can't give their depositors less than 1%. The money's going to go somewhere. They kind of think, oh, it's kind of cute. I'll make a bigger spread. I think that contributes to the problem also. Keeping interest rates pretty low, money started moving around, deposits, that are liquidate. And by the way, you know, one thing that should come out of this, Maria, you know, there are fixed rate securities like treasuries, and they had to sell them before maturities and take losses. Did anybody over there think about floating rates? I mean, was there any risk management to talk about? You guys buy floating rate bonds and rates go up and bond prices don't go down so much. So I think you're going to find a whole bunch of problems here, and it's just kind of like the perfect storm all hit at once for them.